thought of investing in a multi-million-dollar apartment complex can seem like a daunting but exciting task. Should be more exciting than daunting, as it can be a very lucrative and passive opportunity. Today, I'll show you what you will want to consider once you have decided to invest in apartments. Welcome back, investors. I'm Brian Wagers, and on this channel, I'll show busy professionals like you how to invest in apartments without spending hours of your own time. Make the first investment by clicking the like and subscribe button so you don't miss an opportunity. You don't need to be driving a Lamborghini and have millions in the bank account to get started. You can get started in apartment syndication with as little as $100,000 or $50,000 depending on the offering. Besides getting educated on multifamily, like watching videos like these, you'll want to identify 3 factors before making that leap. The first step would be to choose your sponsor or sponsors, which is also known as an operator or operators. Choosing the sponsor is an important step and arguably the most important next step. The sponsor is like the quarterback to your team or like the pilot to your plane. They will be the one or group who finds a deal, underwrites a deal, does due diligence, puts a deal together, oversees management, and implements the exit of the business plan. When choosing a sponsor, it's important to consider their experience, their business plan, how the deal is structured in the standpoint of an investor, and how strong their team is, especially when it comes to the market their offering they are presenting is located in. Which brings us to our next factor in narrowing down your target locations. When choosing a market, you will want to consider the market's economy, their population growth, the price to rent ratio, and local factors such as crime, proximity to amenities, and school districts. These are all great data points to evaluate, but a market that you understand and know is going to be a great one for you to ultimately invest in. Once you have located some markets that you understand the area economics on its own, is a good next step to narrow down on the type of asset classes or classes you want to invest in. Asset classes in multifamily real estate are broken down into 4 categories: A class, B class, C class, and D class. The class is usually defined by the age of the apartment, the location's amenities, and rental pricing. A class being the nicest, working its way down to D class. A class properties being more long-term holds for appreciation, with D class properties at the end of the spectrum usually being highly distressed properties. We specialize in C class properties where there is a mix of both cash flow and forced appreciation through value-add strategies. C-class properties typically cater to your blue-collar workforce housing. There are also different types of builds like garden style, which are 2 stories, to high-rise, which are 5 stories and up. And roof types like pitched architectural and flat roofs. These all can be personal preferences. Having a good idea of a few sponsors that you want to invest with, markets that you have located, and specific asset types are all a good foundation to know before you invest in your first deal. Some sponsors offer a mix of asset classes and markets. Some will have a very specific target that they acquire. For example, Wagers Capital targets C to B class apartments in Arkansas, Texas, and Florida markets, where we can add value to the previous operations and asset and ultimately provide a better living experience for the residents and a better return for the investors. If you like this video and like our recent content, you'll like the ebook that we put out for busy professionals on diversifying your portfolio and building your wealth plan with apartment real estate investing. We have it for you for free at wagerscapital.com/wealthplan.